The Money Show.
Personal Finance with Warren Ingram.
The Personal Finance feature is brought to you by Sanlam Corporate. They take employee benefits personally because when you care, everyone benefits. Sanlam Corporate. Warren Ingram, of course, is a certified financial planner at Galileo Capital. And a reminder, our lines are open, so is our WhatsApp line. If you've got any questions for him on 011 883 0702 and 021 446 0567, you can put your questions to on 072 702 1702. How's it, Warren? Tonight we're talking about the tax year, which is always thoroughly exciting. We're a month away. How do we make sure we get the most bang for our buck from our tax? And I'll start by saying it's actually quite hard to get the most out of your tax, isn't it?
Yeah, SARS are not the most generous lot to those of us that pay income taxes, and so you're right. We don't get a lot of tax breaks, and the few that we do get, I'm suggesting we should do our very best to maximize all the legal things that we can to pay our dues, but not to pay excess.
Okay, I suppose we should start. I should have known you'd start with the retirement fund, and this is about how you make the most from your tax with your retirement fund contributions.
So just to give a little bit of a little bit of background here, we can contribute a certain amount every year to our retirement fund. So whether it's a company retirement fund like a provident fund or your own retirement annuity, and if you contribute up to a maximum of 27.5% of your income, or limited to 350,000 a year for the big earners, you can get a quite a big tax break back from SARS for those contributions. So just to give you a simple example, if you earn a salary that puts you in the 41% tax bracket, and you decide that you haven't maximized your retirement fund contribution, and you top it up by 10,000 Rand now in the next month, that you'll get back around 4,100 from SARS in a tax saving. So it's real, the tax saving that we get from SARS. So making a contribution to your own retirement fund, in other words, investing in your future for you, gives you quite a big tax saving now in the amount of income tax that you would pay in this tax year. So I think it's quite a big one that we should maximize. And most of people's contributions, they're not really maximizing the amount that they can pay into their retirement funds. And it's, to me, a little bit of a no-brainer. It's something you really should be doing.
And you don't have to do this in advance. You can do it sort of at the last minute if you want, one payment. Yeah,
and you know, especially for people who work in the gig economy, or have very variable earnings through the year, they might not want to do a monthly debit order, and so now, just to say, you've got a month to go, and if you calculate what you've earned, whether it's been commission or salary or contract fees, interest or even rent, all the things that attract income tax, it's worth working out what you've earned in the year and then saying, does that have I done the contributions to get to the point of 27.5% of that amount of money? And if you haven't, and you've got the money available, then you really should you should do it now.
Okay. Can you overdo it? I mean, you need to actually do the maths quite carefully here, don't you?
Yeah, so this is one of those things where people disagree with each other in my industry. So if you over-contribute to your retirement funds, you're not going to get penalized, and SARS won't fine you or arrest you or do anything like that. But you're not going to get a tax break immediately. What will happen is you will get a benefit that's very delayed. So when you get to retirement and you start drawing money from your retirement investments, then your over contributions will be beneficial there. You'll get an offset. So some people would just say, well, don't worry about the benefit. Just go and contribute as much as you can to your retirement funds, and then worry about that tax benefit later. I think I'm maybe a bit conservative, but I don't really want to over contribute during my lifetime. I'm happy to do the maximum that SARS allows every year and save money for the rest.
No, sure, that does make sense. All right, medical expenses. I mean, lots of fights about the medical aid tax credit at the moment, as I think there will be for some time. We're not talking about that. We're actually talking about what you pay directly.
Yeah, there is, I mean, for people who spend a lot of money on medical expenses, my suggestion here is make sure that you've got all your receipts and the expenses that you've paid for that haven't been covered by your medical aid, because there is a point when you can actually start to claim those expenses that are unpaid. Unfortunately, it's not for every cent that you haven't been able to claim, and there are all sorts of limits. But the bottom line for the next month is to make sure you've got all your slips and receipts, and contact your medical providers if you haven't, because they might not keep everything by July when you start needing to submit. So get yourself ready now and be prepared now.
Okay. Donations to public benefit organizations, charities, NGOs, things like that. What's the benefit there?
Yeah, not many people know this, but you can donate up to 10% of your income, your taxable income, to registered charities. So they have to be registered with SARS as public benefit organizations, and you get a tax deduction for that. So in other words, if you contribute, let's say you earn R1 million a year, and you do your 10% contribution, that will mean that 100,000 rand of that, which is your contribution, will be deducted from the amount of income that you earn for tax calculation purposes. In other words, SARS will say, okay, for the purposes of this calculation, although you earned R1 million, we're going to look at it as if you've earned 900,000 rand, and then work out the tax that you owe from that perspective. So the reality here is you get a bit of a tax break for doing something very good. And to me, there are people in a position who would like to make donations to, whether it's animal shelters or schools or education funds, whatever it is that's important to you, and use this time now to make sure that those organizations are registered with SARS, and then take advantage of this opportunity to pay a bit less tax and do good with your money in a way that you want to do.
I've always been interested in this, because I kind of sometimes wonder if SARS is going to crack down, if other people are going to get quite cynical about public benefit organizations, if in fact that might change at some point, because it really does allow people to give to their sort of pet causes rather than give the money to government in the end.
I mean, I think the view is that there are so many, very good public benefit organizations that do work that, that government simply cannot get to. And so it would be, I always think about an organization like Gift of the Givers. I mean, look at what they do in towns and situations of great distress. And, if SARS, doesn't do what they can to help organizations like that deliver good to the South African public, that would be a tragedy. So I really hope they don't. I'm very happy that that SARS does the work to make sure that these are legitimate public benefit organizations doing real work and not just tax avoidance schemes. But gee, I hope that never happens, Stephen. That they ban those deductions.
All right, your travel logbook, and this is about a car and how you actually manage what you can claim back.
Yeah, so not everyone gets travel allowances or earns, let's say, commission where you can write off the expense of the journey that you do every day for work purposes. So just to be clear, this isn't about traveling to and from your office every day. If you're an office worker earning a salary, this is not for you. But for people who travel to different places, doing work and earning income at that point, they can get a tax break. And one of the things that people in this situation often forget to do is make sure that their logbook is up to date. So you've got to keep a record of every single trip, the mileage of that trip, and then take note of what your mileage on your car is at the end of February. So don't wait until July and then go, gee, I can't remember what the mileage was on my car at the end of the month and at the end of February rather, and then you find yourself scrambling. So just again, make sure your records are up to date now, because the paperwork is important, and it is one of those things that I think SARS is looking at very closely. And every time people get audited, this is one of the things that trips them up, because they haven't got proper records, and then those deductions for their expenses around their car are not allowed.
One of the things I find interesting about the whole logbook issue for a car is it's quite a lot of PT. Even if you had a good electronic system, and I'm sure someone somewhere has a kind of car logbook app thing for a phone that makes it as easy as possible. You still have to remember to do it each time. And obviously for some people, you travel quite a bit in your car. It really is worth it. I'm sure there's some people who just think, it's really not worth the hack.
Yeah, I wish SARS could find a way to automate this, because it really is a hack. And again, for people who are legitimately traveling for work and incurring expenses and dodging potholes in Joburg and whatever the conditions are, and fires in the Western Cape, it's kind of a hazardous thing being on the road trying to earn a living. And so this should be one of the situations where the technology, I'm sure, is available, and if SARS could offer it to people in that position, everyone's life would be easier. It's such a simple thing to kind of get the taxpayer and the tax man aligned. I agree with you. It should just be done.
For some people, they like to try and claim on an office when they work from home, if you have a home office. Are you able to do that?
You can for example, if it's your primary residence, so it's the place where you live, and you say, okay, I'm going to dedicate some space. I've got a little office that I'm now going to claim as a home office. It's possible to do that. I think again, the documentation and the paperwork around this is very important. And I'll be getting right to the limits of my tax knowledge, Stephen. But one of the things that's also going to happen is that portion of your property will not be treated as your primary residence when you then sell it one day. And why that's important is, if we live in our home and we sell that home one day, if we've made a profit on the sale of that home, we do get a bit of a tax break from SARS before we start paying for capital gains tax. And so if you've now used up a third of the size of your home as a home office, for example, then you might find that you're not getting such a big tax break on the capital gains. And if you live in a place where property prices are going up strongly, it could be that benefit that you got from your home office doesn't outweigh the loss now of that capital gains tax break that you got on your primary residence. So I would suggest someone in this position should do the work just to, go and pay a tax consultant just to walk it through with you and make sure that you're making the right call before you make a decision like this.
So much sort of put together ahead of the tax here. Your questions for Warren Ingram, the co-founder of Galileo Capital, 011-883-0702, 021-446-0567, and of course, voice notes on 072-702-1702. We do have a question tonight, and it goes like this. Hi, I just got a new job with a decent salary increase at the moment. My expenses are matching my income, so the increase would give me some breathing room. I don't want to waste the increased money, but I would like to buy some extras to improve my life a bit. We all need a little bit of ice cream in life, Warren.
The Money Show. Personal Finance with Warren Ingram.
Well, Warren Ingram, of course, the co-founder at Galileo Capital. Some questions coming in for him now. We'll put them to you in a moment, Warren. But first, a question that came in earlier. I've got a new job with a salary increase. My expenses are matching my income, so the increase gives me some breathing room. I don't want to waste the extra money. I would like to buy some extras to improve my life. Warren, how do you sort of judge that? How do you assess what you should do in that case?
I think it's one of those things where, let's say your increase is 10%, then by all means allow your lifestyle costs to increase as well, but don't let them increase by 10% in line with your salary rise. Rather let your lifestyle costs go up by 5%, and that means that you are saving half of that big increase that you've got, and so what you're doing is you're allowing your savings to grow at a faster rate than your salary or maybe than your expenses is growing. So yes, you get to give yourself a bit of a reward, but you don't fall subject to something called salary creep or lifestyle creep, where you just allow your expenses to grow as fast as your income, and then you never get to save enough. Your goal here is save more as you can, and a salary increase is a great time to give yourself that opportunity to save for your future.
Yeah, I've seen that where someone gets an increase in salary and then they kind of, strangely, you get so used to the money you can't get out of it. And actually your options become very limited.
Yeah, and as your expenses rise, along with your income, it's very hard to adjust yourself from that new lifestyle back to the lifestyle you had, one or two increases ago. So the pain of going backwards is much worse than just not going there. And so allowing yourself an extra little bit of breathing room is great, and you should do that. It is a reward for the hard work, but just don't get used to that new lifestyle, and then you don't feel the pain.
Kachliso's got in touch with us tonight saying, "Hi Warren, I've certified, I think satisfied, she means, with my contribution to my RA, and I also max my tax free payment every year. I have the Discovery Vitality rewards between 1,600 Rand and 2,000 Rand every month, and I'd like to deploy it effectively. My portfolio is very poor in crypto. Should I add these funds to my RA, my retirement annuity, or to crypto?" That's Kachliso's question, Warren.
Kagiso, my view is like I understand investments, and I understand how you can value shares and property companies and even government bonds, but I can't value crypto. So for me at the moment, it's one of those things that's evolving. I think I still struggle to call it an investment. I think it's still a speculation. So rather go into the retirement funds than the cryptos.
Yeah, I mean, it's so interesting because so many people will go the other way, but actually some of it is still very difficult to kind of know what's going to happen. Mantombi asks, any advice on a retirement plan? I'm just going to quote this word for word. Any advice on a retirement plan that one can take on the side, and how do I determine the correct amount to add in line with the maximum allowance? Thanks. That's from Mantombi, Warren.
Great question, Mantombi. I think so. The thing that you do on the side, I'm assuming that means that you've got a company retirement fund and you want to do something extra on your own. And for all of us, that would be a retirement annuity. And you can do almost any size contribution to a retirement annuity. So you can either do a debit order or an annual lump sum. And the way to decide on what retirement annuity to choose, look for one that's on a unit trust platform where there's no upfront fees or exit penalties. And then when you're trying to decide how much to contribute, work out what your pre-tax salary is. So if you earn 100,000 Rand a year, then 27.5% of that is what your maximum contribution to the retirement fund can be. So then you can work out what you're currently contributing to your company fund, and you can then do the balance. If there's a gap, you can do the balance into your own RA and choose the investments that work for you.
Okay, now that makes a lot of sense. Okay, at this point in time, Warren, you we're coming to the end of February. That's when the end of the tax year is, but you only have to do the return much later in the year. What's the right thing to do? There's a lot of admin, and you kind of want to get everything in order.
Yep, I think one of the things that people struggle with here is that, SARS, especially if they're going to audit you, what they want now is every document that, that's relevant to your tax position. So you might need every single month's worth of bank statements, your cell phone accounts, your landline, if you've got data at home, all of those, your car expenses, everything. And it's much easier to get it now at the very end of February than trying to scramble around in July or August, if you're then trying to do your returns. Often, you have to pay for those if the statements are older than 3 months from when you're trying to look for them. So my suggestion here is, check your car mileage for the people that do travel logbooks and note that down. Go and get all your bank statements and all the pieces of paper that you need. If you've got investments, make sure you get statements for the end of the February month so that you know what the values of those are and you've got statements to prove it, and save that. So just do all the saving and the filing now. It's much easier than trying to scramble around in July and August, when the time comes to do your taxes.
I've often wondered if there's a specific reason why, if the tax year ends at the end of February, we can't all have to do our returns by the end of March. I've never really understood why there's such a big gap. And it's been like that for years and years and years, that I'm actually sure there must be a good reason. I just don't know what it is.
I've nothing to contribute. I think it's far too long and it's far too late. So I feel like it makes sense that sometimes it takes a bit of time for the providers to give you statements and to actually collate those, your IT3s or your RP5s from your employer. But surely nowadays, we're not doing this by paper anymore. It should be a bit faster.
Very quickly, in 30 seconds, how do you know when you need a tax practitioner?
If you've got, if you earn more than just a normal salary where you're just paying your normal taxes and you earn, a variable income and you've got, things like this home office conversation, all of those situations, then it's worth your while just to consult a tax practitioner to make sure you're doing the right things before it's too late. And doing it now where you've got a month to top up retirement contributions, etc., it makes sense to me.
Thank you very much indeed, Warren Ingram. Really do appreciate it. Co-founder of Galileo Capital with personal finance on The Money Show.